Provident Healthcare Partners is a healthcare investment bank that is focused on transaction advisory services. We created this podcast for healthcare executives, entrepreneurs, shareholders, and providers who are interested in learning more about the world of healthcare consolidation.
Welcome to the newest episode of our Dealcast. This is Ajeya Shekar speaking from Provident Healthcare Partners. We've done a few podcasts already on topics such as why healthcare is consolidating, what types of deals there are in the marketplace today, and what an investment bank does through a transaction process. But we wanted to take this episode to talk through one of the most common items that we discuss in conversations and meetings with potential clients and existing clients, which is just around the topic of private equity. What is it? What are their motivations? How do they function as partners to healthcare businesses today? And we wanted to invite two colleagues of ours, Kevin Palamara and Robert Aprill, who work on a lot of our private equity transaction processes, to answer some common questions that we get from healthcare companies on the nature of private equity. Just as a quick introduction, Kevin Palamara is a managing director at Provident Healthcare Partners. He's been with the firm for about 16 years and works on a number of private equity transactions across various subspecialties of healthcare services.
Thank you, AJ.
We also have Robert Aprill. Robert's an associate here at Provident. He's been with the firm for about 4 years. He works on a lot of private equity transactions within various physician specialties in particular.
Thanks, AJ.
Great. Well, appreciate you both joining me on this podcast today. Maybe to start off with, it would be helpful for our listeners to hear an overview on private equity. Robert, would you like to start us off?
Absolutely. So typically when we have initial conversations with businesses and healthcare service-based businesses, the first thing that they're interested in really is understanding what is private equity and how does it function in the healthcare services market. Generally, the business owners that we're speaking with they're founder-owned and operated businesses. They're physician-owned businesses where private equity really doesn't come into play on their day-to-day lives. And so understanding how these funds are structured, how they make their money, and ultimately how they work with business owners becomes a big point of education in these early discussions. And so just to answer AJ's question and what a private equity fund is it's essentially a pool of capital that a management team uses to deploy and make investments in the private market. So that capital comes from a number of different institutions such as wealthy individuals, pension plans, insurance companies, and endowment funds. And the reason why these different entities give capital to private equity funds is because it allows them to invest in the private markets on top of what is likely the capital that they've invested into the public markets as well. So it allows them to deploy capital through a management team into a number of different privately held businesses.
And what do we typically see in terms of their objective by investing into privately held businesses?
So typically these management teams will look to deploy capital into a number of different investments with time horizons anywhere from 4 to 7 years. And so the typical fund will have a 10-year horizon or a 10-year operating timeline. Well, they'll spend the first 5 years in making investments into different companies and the second 5 years exiting those investments. And so within the healthcare services space, this typically comes out to about a 4 to 7 year horizon from which they make the initial investment into the business and then look to exit it at the end of that investment cycle. The way that these private equity groups make money is ultimately by buying into a business, spending those 3 to 7 years growing that business, and then at the end exiting the business for a much higher equity value than the initial investment. I think a lot of times business owners are worried that private equity groups are going to come in, strip costs, cut people, and use it as an annuity to strip cash out of the business. And simply put, the size of these transactions and the way that these businesses function, it's simply not a economically beneficial way to run a private equity fund. The way that they look to make their money and how they're successful is by buying a business for $1 and selling it for $5 in 4 to 7 years.
So we've heard a little bit about an overview of private equity from Robert. Kevin, would you mind sharing a little bit about how private equity generally structures these transactions?
Yeah, so there's really two different school of thoughts when it comes to private equity and how they structure transactions. And, you know, it's much different than the typical, transaction a business owner might be used to, where it's 100% purchase of their business, an all cash type of transaction. Our more common, what we've seen more commonly, AJ, as you know, is a majority recapitalization, which is a private equity group coming in and acquiring anywhere from 51 to 80, 90% of the entity. And then on the other side, there's minority transactions where a business owner may want to retain control of the business from an equity perspective, and they'll come in and they'll acquire a majority position anywhere from 10 or 20%, maybe up to 49%. It's really about aligning interests and aligning risk when it comes to private equity. We deal with a lot of business owners and physician groups who have younger shareholders and maybe have a long headway in their career, and they want to retain that equity and get what is known as the second bite of the apple on the second transaction, which we'll talk about. And the other way that private equity transactions are a bit unique is that the structuring of these deals is typically what we call a leveraged buyout or leveraged recapitalization, where they're using equity from their fund along with outside debt, from a large bank, a Wells Fargo or somebody along those lines, to value the business and to structure these transactions.
And in your experience, how many deals go the majority route versus how many deals go the minority route? And is there any difference in valuation based on each structure?
Yeah, I think that it's safe to say that our experience in the marketplace has shown that there is a preference for private equity groups to have control in transactions. Over 90% or more of our deals at least have been majority transactions where they have come in and acquired, I think our typical range we would say is 60 to 80% of the business. Also, I think a valuation difference when you think about majority versus minority transactions. There's what is known as a control premium. So a private equity group that has the ability to acquire, a majority interest in your business will typically pay a higher valuation than a scenario in which you're only willing to sell a minority position in the business.
Mm-hmm. Yeah, I think one of the kind of lines up nicely with kind of the next question that we most often get from clients and potential clients of ours, which is if they're in a minority equity position, how does life really look like in terms of the management of these companies post-transaction? Just in both of your experience, and for the benefit of our listeners, what's the general approach from private equity to managing these businesses once they've made an investment?
Yeah, I think that the approach, again, we talked about alignment on the last one of the last questions, AJ, and I think that it really just depends, on the management team. And, for example, we work with them up front and kind of determine, is this a business owner who's in this for the long run? What is their vision for the business? Where are they in life and what are they looking to do? But I think that what we've seen, especially in the last 5 years or so with private equity, is a very flexible approach to management. If there is a management team that wants to continue running the business and manage day-to-day operations, there are certainly plenty of opportunities to do that. I think that one of the things that may change from an administrative perspective post-closing, there's certainly going to be a lot more oversight and reporting and key performance index measures that they're going to be looking for on a more consistent basis than you may be used to in running the business on a day-to-day basis. I think that's probably one of the areas where you would see the biggest amount of change. If you're a physician group, if you are a practicing physician, and really for the most part, in the day-to-day operations, you should not see any change in what's going on. A private equity group does not come in and kind of take an office in your headquarters or anything along those lines. They will be as hands-on or hands-off as you would like in your process, and they're there to add value, whether that's with their own resources, if you need certain positions to be filled. I think our experience would show some of our clients maybe need a stronger CFO, maybe they need somebody to help them specifically with mergers and acquisitions, but it's really tailored to the needs of the specific organization. We've had clients that have lots of infrastructure and they really don't need a lot of help from the private equity, with the exception of maybe some capital. And we've had other clients who have been very honest and said, look, we need infrastructure, IT, human capital, and certainly the capital for doing growth both internally and through acquisitions.
Yeah, I think it's very different today compared to what the old models of call it Bain Capital, where they would acquire the company, allow the management team to cash out 100% and kind of use more of their consulting backgrounds to run the company more efficiently than what the existing management team had done. I think what we're seeing today more often is your point, Kevin, about that flexibility in their objectives in terms of adding more management where needed or taking more of a hands-off kind of board level approach. And I think that's one of the items that certainly drives value in some of these private equity transactions. But I guess in both of your opinions, what are kind of the couple key ways that private equity helps these shareholders of healthcare businesses achieve that 3 to 5 times return on their rollover equity in these deals?
So typically the groups and the businesses that we're working with are ones that are already experienced a history of growth, whether they've reached a plateau and that's why they're looking to approach the private equity community is taking that next step in the business life cycle, or they've been growing for a number of years and are looking to capitalize on what they've built. These are businesses that have a track record of success, so the private equity groups aren't coming in from a turnaround standpoint and aren't coming in to really change the direction of the business and more so amplify the rate at which they've been growing and really just build and continue to build the business in which that the management team has either started the business or has been building it over a number of years. So when we talk about how does a private equity group help build the business, one of the comments we often get is, why would a private equity group know how to grow my business better than I do? And typically it's not a conversation around doing it better than you are. It's just a conversation around helping you supplement what you already have and helping you amplify the growth rate that you've had over a number of years. So it's about really building out a laundry list of items that you likely already know as a business owner that would help build your business and add to the bottom and top line of that business. But it's about doing a number of those initiatives at once. So whether you're a physical therapy company that needs to add locations, and historically you've added 1 or 2 locations a year, but with the capital of a private equity firm and the additional resources that they bring, you can now add 5 to 10 locations a year. Whether you are a orthopedic practice and there's a number of locations where you could benefit from an MRI or benefit from a x-ray machine, but you don't have the capital and the owners aren't willing to personally guarantee the debt to make those capital investments. But with a private equity group, you can make those and add those service lines to those different locations. It's really about taking what you likely already know would benefit the business and having the ability to have a capital partner to help you make those investments. So one of the benefits of partnering with a private equity group is the ability to leverage their relationships with lending organizations. Typically, our clients have pre-existing relationships with local banks and are able to leverage that debt to build out some of their business units. But the ability to leverage the relationships private equity groups have with debt lenders allows you to, no longer personally guarantee debt at the shareholder or the partner level, but also to be able to utilize larger amounts of debt at more favorable financing terms. Additionally, they'll look to help supplement areas in which the business is in need. So if the management team, as Kevin mentioned earlier, you have a CEO and a CFO, but you really would benefit from adding a COO or a CMO or a corporate development officer, whatever it may be that would help supplement and really make the lives of the current management team easier. Those are the types of things that the private equity group would look to come in and assist with. One of the largest things within healthcare services, specifically that private equity groups look to target, is an acquisition-heavy strategy. Typically, in all of the physician services world, acquisitions are going to be a big piece of the investment thesis private equity groups use to leverage that investment. So whether that's you making smaller regional acquisitions that are smaller competitors in your geography, or whether it's making larger acquisitions in the greater national market, these private equity groups can help you not only seek out strong acquisition targets, but help you structure them in a favorable way, which benefits both the business, but also the individual shareholders as well. Because as Kevin mentioned, these partnerships are true partnerships in that as the equity value grows in the greater business, it benefits the original selling shareholders from the business as it stands. So having access to the expertise of a private equity group from an operational standpoint, but also from a corporate development standpoint, really benefits the shareholders and amplifies the growth rate in which the business has seen historically.
Yeah, I think those are all great points. And from what we're seeing here at Provident, it's that more private equity firms are being created with a focus on healthcare. There's more capital being deployed into healthcare overall from the private equity community. So it really has to come down to these, value-added resources they can provide outside of just capital, because really the capital seems to be the commodity these days.
Yeah, I think, and we'll probably touch upon this at some point in the discussion, but I think that is one of the biggest drivers in the last 5 years within private equity. It is a exceedingly competitive marketplace because, capital is, debt is still very cheap. Valuations are very attractive. It's still a very seller-friendly marketplace. And what these private equity groups have had to do is really differentiate themselves. And what we have absolutely seen in the last 5 years is we've seen new private equity groups formed. We've seen existing private equity groups take more of a focus on healthcare services. We've seen private equity groups, and certainly we've seen this in the last couple of years, developing theses in certain sectors, like dermatology, ophthalmology, home healthcare, and hospice. It has made them very competitive in a process, and it's really helped them differentiate themselves as not just a capital partner, but a value-add partner to our clients. And I would say that more times than not, we end up going down the road with those types of groups because valuations remain very attractive, and these private equity groups really had to find a way to differentiate themselves.
I think from a pessimistic viewpoint, a lot of our clients think about where private equity can go wrong in these sorts of investments. You hear stories of where private equity comes in and fires all the management team involved. We've obviously seen the headlines about the Toys R Us LBO kind of catastrophe that happened. In your experience, where can some of these private equity deals go wrong, and kind of what are the situations that lead to those negative outcomes?
Yeah, that's a great question, AJ. I think typically our initial conversations always center around kind of the horror stories that you read in the Wall Street Journal or you see in the front page of the newspapers, where the big bad private equity group comes in, buys a business, fires everyone, and on and on and on. And so you have to kind of take that with a grain of salt when you're talking about the types of private equity groups and the types of businesses that we're talking about here that exist in that lower middle market, that exist in the healthcare services space, where these aren't turnaround stories, as I mentioned earlier. These are businesses that have experienced a history of growth and are now looking for a capital partner to help amplify that growth and take them to the next level. So typically it's more about making investments into the management, as Kevin alluded to earlier, where you're actually adding bodies and adding roles in management as opposed to firing and replacing, because typically the reason the private equity group is making that investment into that lower middle market business is because the management team has a strong track record and has had noted success in the past. So the reason why they're making that investment is because they believe in that management team. And so it's about finding and supplying resources for that management team to continue to be successful at a greater rate. So typically, and most commonly, the horror story of coming in and firing everyone is just simply not something that happens, especially in the physician world, where the nature of the business is a provider providing services to a patient, and they are the true revenue generators. So compare that to a product company where you can come in and replace the management team with the private equity group's own management team and continue the business in the sense of a provider-based business, or specifically a physician-based business where the physicians are the owners and are the revenue generators. That's an instance where you can't come in and simply replace them at the whim of the private equity group or replace the management team, because all of a sudden you have an unhappy set of revenue generators. And so that control over the business remains as long as the physicians continue to generate the revenue for the business. They'll continue to always have that control over the direction of the business.
Yeah, and AJ, you mentioned the Toys R Us, the news that's been out there about what's happened with them, and the concept of, going in and chopping heads and increasing profitability. That's just a very antiquated model. It's something that certainly does not apply to healthcare, certainly does not apply to the lower middle market, and something that we certainly have not experienced, in our 20 years.
Yeah, I think, we've often seen that private equity groups try not to create an uncontrolled growth model. It's really hiring the people that you need to service that growth and, actually creating a lot of jobs on a local level rather than taking them away.
When you think about really the worst case scenario, the doomsday scenario that everyone fears when you start talking about selling a majority piece of the business or partnering with a larger financial sponsor, a lot of the things that would cause that doomsday scenario or that investment really to fail are the same things that would cause your business to fail today. It's large stroke of the pen risk. It's changes in reimbursement where things are no longer covered by Medicare or Medicaid. It's things of that nature that would have drastic impacts on your business today are the same things that would really impact the business after a transaction like we're talking about.
So in an ideal world, the private equity group generates a significant return on their invested capital and the equity value for all shareholders involved. But could you walk us through the process in which they actually return that capital to the shareholders and how they earn that money?
Yeah. So again, the way that these deals are structured, typically you're having shareholder groups, physician groups. In the initial transaction, they're retaining 20%, 30%, 40% of their equity with, the promise of, a return on that rollover 4, 5, 6, 7 years down the road, as Bobby had mentioned. So there becomes a period in which the company has grown. You've doubled, tripled the earnings of the business, hopefully over that period of time with your private equity partner. And they need to get out. I mean, they're not going to sit in this in a deal for 10, 20 years. That's just not the private equity model. So at some point in time, there'll be an inflection point. If you are still with the business as the CEO, as the manager, which happens many times, you'll be on the board and there'll be a decision made at some point in time, and it's usually driven by the market. You're getting a lot of incoming interest and it's the right time to do something. So they'll go through, you will go through another process very similar to what you would have done on the first transaction as a more professionalized business, a larger business, and what are your options at that point? And there's, probably 3 options that you're probably looking at that point in time. Within the healthcare world, within the provider and the service side of things, I think our experience tells us that probably the more likely opportunity is for you to kind of scale up to a larger private equity group. When you look at the private equity community, we haven't really talked about this, but there's different sizes of private equity groups. There's the private equity groups that can do deals that are $10 million to maybe $100 million. Then there's that next level of private equity that can maybe, they're looking for a minimum of $100 million deal. So that's usually the next landing spot for a lot of these businesses. And again, you could go through the same process all over again. You could do a deal in which you have your 20, 30% of retained equity. Maybe you sell 100% of that in the second transaction. Maybe you roll some of that equity back over. But that's what we've seen. We've seen a lot of these businesses in the healthcare world kind of get handed off from private equity A to private equity B over time. And we've seen that certainly in the dental industry, within healthcare staffing, within some of these other physician sectors like anesthesia and hospitalist. Because again, in a lot of these spaces, there isn't a large national consolidator. I would say though, however, that another option could be selling to a large consolidator. We've had some experience recently, obviously, with some of these large groups like United Health through their Optum division. There are some large publicly traded companies within the healthcare world that are consolidating. And there's also private equity-backed groups out there that are consolidating as well. So, I think that that's your second option. And then, probably option 3, depending on where you're at in your life cycle, and we don't see this a lot in healthcare services, is doing a public offering. We've had a handful of our clients that have kind of taken that second bite and chosen to go the IPO route. But again, if you really look at the IPO marketplace, it's very rare to see a healthcare deal go out and do an IPO. So that would be your third option, but probably the far less likely of the 3.
You talked about this a little bit in terms of it being kind of a board level decision as far as when the right timing, what's the right timing to go through the secondary deal and who do you essentially do that secondary deal with? We do so many deals and with provider-based businesses, and I'm sure some of the people who would be listening to this podcast are probably provider shareholders themselves. What's your opinion on kind of their say in terms of who they do a deal with, and what timing of that? What is the timing of that appropriate second transaction?
That's a great question. One we deal with a lot in our deals, and one of the great things about being a healthcare organization, in particular, if you're a physician group with a large shareholder base, you do hold a lot of power in terms of where the transaction is going, right? Because there's certain sectors where you might just have physician groups that say, not in a million years would I ever work for this strategic group. I think in the physician world, we know that within some of those hospital-based organizations and ASC groups, there's a real, hesitancy, I would say, at a minimum, for these groups to get partnered in with those large conglomerates because they just think their culture is different. And as a shareholder and as someone who's driving revenue, especially in these groups, it'd be very hard for the private equity group to kind of force you to go down that route. So the decision is collaborative, and typically you're on a board, with this private equity group, and usually you just kind of know when the time is right. It could be early. I mean, we've had some of our clients go through a second process in 2 or 3 years because the market has just told them the time was right. They've been getting a lot of incoming interest. The valuations may be very attractive, and I think it's a collective decision. It's not forced upon you by the private equity group, or at least in our experience, it is not forced upon you by the private equity group. And typically it's an aligning of interest at the board level with management, and you just kind of go through the process once again, and again you vet out your options, and you're going to end up with the group hopefully at the best valuation, and that's the best partner.
From just a qualitative perspective, in your opinions, what's the most important thing to consider when a business is evaluating potential private equity partners?
Yeah, I think there's a lot of things to consider with private equity groups, and maybe thinking back over 5-10 years ago, it was tough to kind of differentiate these groups. They all kind of looked the same. They all had the same story. I think in particular, because we've done so much in the physician world in the last 5 years, I think this is a great example, is these are much more complicated deals. A physician group, again, just using that one example that may have 10 to 100 different shareholders, is a much different deal than a single shareholder run business in maybe, the post-acute care world or the staffing world. And we ask these private equity groups tough questions. We want to understand, how have you worked with a physician group before? How have you thought about recruiting? How have you thought about compensation and growth? And it's tough for some of these private equity groups to kind of answer some of those questions. So I think we've been, taking the approach that, depending on what industry you're in, and again, I'm using the physician practice world as an example here, because I'm sure there's some folks on right now that are physicians or are part of a physician group. But that is one of the things I think we really look at, is how can a private equity group kind of leverage their experience in the physician world with many shareholders in these broad deals as a real value add partner, and looking at all the intricacies of running these types of businesses moving forward. I think there's other things that are just, like personality. I mean, again, we get into a deal and you could have, 6-10 great options. You're meeting with these guys and these women, and they're making tremendous offers for your business. And at the end of the day, it may just go down to personality. I mean, I'm telling you, it has happened on a lot of our deals where, valuation being equal, fit being equal, do I like these guys? Can I this is a partnership for 5 or 6 or 7 years, maybe even longer moving forward. And you got to feel really comfortable with these guys. And I think that, quite honestly, personality and cultural fit plays a huge role in how a lot of these deals get done. It's just, do I like these guys? Can I see myself, sitting on a board with them for the next 5 years? Do we have the same vision? Do we have, the same aspirations? And, that's more of an intangible type of thing, but I think that does play a big role in these private equity groups.
I think that wraps up all of the questions that we were hoping to go through, and the most common Q&A we get from potential clients, existing clients about the private equity model. I think there's a lot more details we can get into, certainly on future podcasts, on how this applies to different situations, how this applies to different sectors of healthcare services. But hopefully this has been a good overview for everyone, and appreciate Kevin and Robert to take some time to record this podcast today. What we'd love to hear from our listeners is if they have any further questions about the private equity model, or even any other questions or ideas on what topics might be helpful for them as they think about the M&A world within healthcare services. So please feel free to reach out to us by email at podcast@providenthp.com. Feel free to leave us comments and ratings on our iTunes site, and where you can find these podcasts, and look forward to hosting another podcast in the near future.